Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. Jeff, how are you?
Ryan, I'm great. How have you been?
Like we were saying, not a shortage of things to talk about.
You said it.
Yeah, it's June 9th. We might as well just timestamp exactly when we're talking. So in case we missed any ridiculous things that has happened between now and the release date. Maybe I was thinking, because I got a list of a handful of questions and stuff that we can, of the trends that we've been tracking, Jeff, but maybe just from the top of what's been the conversations, between the closed doors that you're in these days? Anything that's top of mind of everybody you're talking to?
Yeah, I think there's obviously a lot going on, big picture macro wise that people are keeping their eye on. If you think back several months, there was this whole Liberation Day and announcement of tariffs and
Was that even out yet? I don't know if it was yet. So we had, yeah.
Yeah, it was crazy just to see, all the threats of increasing percentages, and then 2 days later it was, even higher, and 2 days after that it was even higher, and then and then it was, okay, we'll go a little over here, and then we're gonna go triple the amount. It was just so bizarre, and it was flying so quick that nobody really had a good sense of anything, right? No one really had a good sense of what any of this meant. I remember some clients calling us up saying, well, we gave you our forecast, and we're probably going to need to revisit that because we're talking through our supply chain, and we're hearing that our contract says X, but the manufacturers have some reasons why they believe that provision in the contract's no longer valid, and that we're going to get hit with higher costs because of these tariffs. And then a week after that, the whole tariff situation changed again. There's a lot of companies, that had anticipated the year to go a certain way, and then you get a lot of this uncertainty just thrown at you. And so for a while, no one really knew exactly what any of this meant.
Was it just people just pausing and being like, this is just too tumultuous to even like the repricing almost probably didn't make sense after a period of time to just be like, yeah.
No, people didn't even get to the point of repricing in a lot of instances because they didn't know what the price was going to be.
I know. I just have to give you two data points from my clients, Jeff. One is a Canadian manufacturing distributor, had a very large sale on the table. And he's like, yep, it's all gone. So he goes, so he engaged going I don't necessarily want to sell now. I want to reap the rewards of my own business. So I'm just going to look at my cash, look at my valuation from a cash flow valuation. I got another client that's a distributor in the building products space, Jeff, and he called me up and he's like, he got on a call. He's like, well, 56% tariffs on doors from China now. He's like, I don't even know what to do about this at the moment. So yeah, it's been wild.
Oh yeah, no, it definitely, was so crazy. And because of that, everybody just decided to go pencils down on a lot of things, right? We had a number of transactions where people just said, listen, I don't know how this is going to impact my business, and I don't know how it's going to impact your business. And we're talking about the transaction amongst the two of us here where I'm buying you or vice versa. And both parties look at one another and they're like, what's it going to mean for your business? I don't know. What's it going to mean for your business? I don't know. And so everybody's like, well, I guess we just have to go pencils down. Okay. And wait until this whole thing sort of plays out. Right. And
everybody's looking at you guys and going Jeff, tell me the crystal ball. What's going on, man?
Yeah. It was nuts. And as you might imagine, that means that no one really knows how that's going to impact the P&L. No one really knows the order of magnitude how it's going to impact the P&L. And so if you're trying to borrow money at this particular point, the lenders are wondering and asking a lot of questions, and the finance team doesn't have any great answers. And so, the lending community is now sitting there going, well, what we need to be a little bit more cautious when maybe what we're willing to lend, because we need to, they tend to obviously want to always sort of underwrite to some worst case scenarios. And And if you don't know what that is, it makes it difficult, right? And no one had a crystal ball. So it just kind of stopped everything. And everybody I was talking to, I was, other finance professionals, I'd say, what's going on? What's happening? And the answer was universal: nothing. Everything just stopped. No activity, not, private equity firms that were really active just kind of went pencils down. Lenders that were in the middle of things kind of went pencils down. Um, so it's been crazy. I mean, obviously there's been a bigger impact to companies that have some sort of exposure to international markets through their supply chain and would be, more directly impacted by tariffs, right? There's still activity going on and today, and essentially it involves companies that have little to no exposure to the tariffs.
Yeah, like the common sense approach sniff test is like probably very tried and true right now, which is like, okay, show me where your income's coming from and what's the risk. And then really, it's just trying to find pockets of certainty in the uncertainty, right?
Exactly. Yeah, yeah. So if you can find that, and if you're one of those companies and you're looking to do something, it's still probably not a bad time. But you have, for outside buyers, serial buyers of businesses, is trying to sift through a lot of this. A
Hey,
lot of it.
what's the as the conversations, um, are people getting numb to it yet? Or is it like to the point where like there's going to be some thawing and there might be some deals getting done because it's so volatile that it's like, hey, I don't know if any of this is going to happen. They start second guessing any of it and they're still just moving forward. Or what are you seeing?
Yeah, I think if you're talking about financial buyers, they're pretty much still on the sidelines, right? In large part for companies that have some sort of exposure to the tariffs in some way, shape, or form. I think a lot of strategic buyers, they might be interested in making an acquisition for, competitive reasons, right? They want to pick a competitor. They kind of maybe have a little bit more of an understanding and appetite, on both sides of the equation, right? How it's
Right.
going to
Well,
impact
because
their
they
own
know what
business.
they know what their exposure is and what the price might be for someone that they want. Like, yeah.
Exactly. And so I think there's a little bit more of an opportunity for a transaction involving two, strategic businesses to continue to press forward. Just because there's a greater motivation to make this acquisition because you're maybe taking a competitor out of the marketplace, right? And you've got all sorts of other strategic value you might be able to extract out of it, and maybe you have a greater appetite for the understanding of the supply chain, the potential tariff impact. So you're willing to kind of stomach a little bit more of that risk because you're living in it every day.
Yep. 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 How does that extend to ESOP transactions too? Because I mean, if you know what risks you have, you could probably more clearly articulate them to the ESOP advisors that are working on a transaction.
Yeah, absolutely. Again, it goes back to how much or how little exposure you have to tariffs, right? I mean, we just as a firm closed a transaction last week, one we had been working on for a while, and it's not really impacted by tariffs, right? So that one continues to move forward, and it was an ESOP transaction. And I was just on the phone earlier today, talking to some business owners that are kicking the tires and thinking about moving into the ESOP structure. We're going to put together an ESOP feasibility analysis for them to kind of show them a good, picture of what they do about what a transaction could look like. And they're a more localized, B2B services company that doesn't have any exposure. They provide services, professional services to office buildings, and so there's opportunities in the ESOP world for companies that just don't have that same level of tariff exposure. I think the financing piece has also aided that the continuation of these ESOP transactions because there's still a lot of capital out there, right? And again, there people are looking to lend into businesses, right? And now with fewer maybe opportunities because some businesses are kind of off the table at the moment with all the tariff
They've
exposure.
got to still get deals done. Yep.
The lenders are saying, okay, well, I mean, now there's fewer deals to go around. My ears are piqued by this over here that maybe I otherwise wouldn't have taken a look at because of some reason X, Y, or Z. So there's, opportunistically, if you're the right kind of business without the exposure and you're looking for money, there's an abundance of capital out there. Terms are, improving by the quarter.
What are
And
some of the things that you're seeing improve on the terms side from the lenders?
I think we're seeing lenders that are willing to be a little creative on repayment terms. They're willing to be
What are
flexible
some
on,
examples?
yeah, on some of the maybe their fees that they would charge, up front. I mean, there's been, I think, an improvement in interest rates, but I'd say, nothing that is drastic because the Fed hasn't still yet, lowered interest rates. So that's
It's
helped
just a
somewhat
shit.
calm
It's just a shit
concerns a
show.
little bit.
Oh, you're
Yeah.
earning your fees, Jeff, is my guess.
Oh boy, yeah, you said it. There's definitely there's definitely a lot more work,
You
just
feel
to
like
get,
you're on one of those
come
like
up.
things that like moves all over and you're trying to keep your balance. Oh,
Yep.
it's like those balls with the like the
Yep.
stability table or whatever, or that. So like on the lenders, I'm curious when you say that the flexible terms and creative, I think um and maybe my question about the lending environment could nest inside of what I found in the last couple podcasts I did, Jeff. So I'll lay out some landscape for here, and I'm curious on how I think you can provide some good insights. Is so I had this guy on the podcast. He does a bunch of business brokerage in the Main Street, the Main Street businesses, and he was providing more and more context to the size businesses that he deals with, which are not my typical clients. Right. So he actually had this. I mean, he made up the term. He calls my clients whale sharks that are like founder led owner operators who want to run their business like private equity and do M&A and, sit in the boardroom, maybe sell their business, but it's a very small, narrow chunk of the marketplace. And so, because I think you could help us provide even more context and relativity for the listeners in of like, okay, we're these different pockets of the market, they come with different implications and different options for financing and liquidity, options for different advisors like yourself. So what I wanted to do is just kind of lay some groundwork and want your thoughts and course correcting me or kind of like filling in some gaps. So like Main Street businesses, like when this guy Clint was talking, those are all types of businesses that some of my clients are buying. So like it's the million, $2 million add-on, right? So they're not PE funds, but they're the competitors in the middle market that are doing some of the stuff that you're talking about. And because it just like makes sense. They're like, if I get this revenue, I can like literally plop it into my P&L, understand what the return I'm going to be. And it's like, you shouldn't do it on the back of the napkin, but you can kind of do it on the back of the napkin, make it all work. So that Main Street businesses are so dependent on the business, like the actual founder. There, a lot of them are jobs. There's SDE and not necessarily even normalized EBITDA. Then there's like what I call no man's land, which is like call it $1 million in normalized EBITDA to like three. And then there's like the 3 to 5 million in normalized EBITDA. And I say all that because as I'm going through your GF data stuff, like providing ranges of like, okay, here's in this marketplace types of services and options that they might have versus this type. Because like in Main Street, it's a lot of business brokers, SBA loans, right? Then there's like the places that I'm working with, which like creativity becomes a really big deal because like some people like might have a good infrastructure and want to do an ESOP, but then it might not be big enough. And I've also started to see some inflation creep on advisors like yourself, where like, and I'm not saying this about Butcher Joseph, but other people like yourself who are great, amazing advisors, but you have to use your time wisely. And you're like, well, we can't go down market to this. So I've been working like, a lot of my clients between 1 million and like 4 million in normalized EBITDA. I've got some bigger. Maybe kind of help us take from the Main Street to, like kind of the middle lower market, like I'm talking about, and then some of the other stuff, the other ranges that you're playing in. And does that make sense? Am I making sense? Because I want to make sure I'm not rambling too much because like the investment bank, that like your services, but then also ESOP availability, interest from private equity firms. I think what I learned over the last month, giving those parameters for people has been very helpful because I don't think it's readily available as much as people would want them to go, okay, like who actually should I talk to? What actually are my different types of options to determine, should I grow the company for another 2 years to get Jeff's help and then do an ESOP or private equity, or should I play in my sandbox that I'm in right now?
Right. Yeah. Yeah. No, I mean, those are key questions, for a lot of business owners is just that, question around the timing of when, you might seek a liquidity event, and what sort of opportunities might exist near term to kind of improve the potential outcome. And sometimes, now's not the right time for a variety of reasons, but you put certain initiatives in place, with the idea of making sure that a couple years down the line, maybe the timing is right for your business, and you've got, from now until then, the opportunity to kind of pretty up, some of the areas of the business to make sure you're getting sort of the best outcome.
I think the
Um,
most the
Optionality.
optionality,
Yeah.
right? Like my clients keep saying that word optionality, and so they're like, maybe we can help of like, where do you play for ranges of companies? Like, honestly, I think it would be very helpful everybody to say, Butcher Joseph, like, what is your filter of like ESOP ideal clients, private equity? Like if someone wants to sell to private equity, like what is your ideal client and like in the various services? Because I think I've, I've referred you, or I keep talking about you to my clients where people are wondering, are we interesting enough? And I think it's a great thing to strive for like the middle lower market to work with the services that you guys have.
Yeah, I mean, you start to look at companies that have the most options are going to be the ones that have EBITDA of say $5 million and up, right? And that's typically, a pretty good representation of the types of companies with whom we work. I think the other thing too that is important in the context of an ESOP transaction is because it is a bit of a levered transaction. It's important to have be able to have good evidence of steady continued growth, because I think if you can't demonstrate that, it's going to be hard to be able to kind of understand and really sort of triangulate around how much debt you can comfortably place on a business in order to facilitate a liquidity event. Private equity firms view it the same way, right? Because they tend to lever
Oh,
up the balance sheet. And so I think, that being able to have that sort of fact pattern in your rear view mirror, and when you get to be a size of EBITDA of like 5 million, you have a lot more options available to you when you would be able to kind of demonstrate those fact patterns. It gets a
because let's
lot more
break this down, because that was so helpful, because almost verbatim what I said on my owners academy call this morning with my group, because I was like, we were talking about the different buyer types. You and I had a podcast about that a handful of months ago, like 3 to 6 months ago. I can't remember what it was, and we'll put that in the show notes. And we were talking about the different buyer types, but when I kept hammering home today was like, yes, we have the normalized EBITDA, the multiple, net debt, and normalized working capital is the 4 KPIs that everybody's got in the owner scorecard that I've created, Jeff. And it's like, great. Like that's the market valuation where you're looking at ESOP, private equity, third party sale, like all that, like those 4 KPIs are going to be important. However, at the end of the day, I'm like, it's all about how much cash you can service in debt. Like, and so like, and I said, ESOP, private equity firm, anybody's gonna, like, most people are gonna buy it with debt because it's a dumb investment choice to put all cash down. So with the different ranges of normalized EBITDA and like those, that's why I think that size becomes so important, because walk us through like what the conversations are with the bank and the buyer about financing and debt on the different size of companies as you start to, because like that, the more fundable it is, the more options you're going to have. Because I think it's so important, because you go, and why the 5 million kind of becomes this sweet spot compared to the mid, like what I would call where I'm playing, where like it's like a combination of the lumpiness of the cash flow, but also like the cash flow, working capital, debt, taxes, and owner's distributions. It just becomes a tighter constraint, and it's just a fact of it, of the numbers.
Yeah, yeah, it does. And I think that number is it's kind of it's certainly not a bright line, right? It's not, like if you miss it by a couple $100,000, it doesn't mean your options change all that much, right? I mean, but
It's
just a
like a bell
general.
curve around that 5
Yeah,
million, right?
yeah, exactly. Just a general rule of thumb. When you kind of round that size, you have more options because you usually, have a bigger business, more diversification involved in your business. Maybe you've built out your leader team a little bit. From a lender perspective, maybe you have you have a little bit more collateral on the balance sheet that lenders can look at and get comfortable
What
with.
if you don't? What if you're a professional services firm like you're talking about? Because like I've got plenty of services where they're doing 5 million normalized EBITDA, and it's like, there's not a lot of machinery for that bank to
Right.
collateralize.
Yeah. So really, for professional services firms, it's going to be a little bit different in terms of availability because you don't have those hard assets to lend against, but you do have things like receivables, right? And that's banks will typically look at the receivables and loan against receivables. Um, that's going to be the predominant asset on the balance sheet that they would use for determining how much credit would be available. There are other lenders, of course, that would take a look at that and then also take a look at the cash flows of the business, right? And
What a concept.
yeah, loan against those cash flows. And so your borrowing capacity may not necessarily solely be limited to the
Collateral. Yep.
collateral
Yep.
receivables in this case, but it's kind of a starting point for a lot.
Well, and that's why I'm constantly harping on the 3-statement forecast, because if they can prove their future working capital, debt, taxes, and cash, then they can prove what lending can go against that future cash flow, and then therefore it decouples it from like the balance sheet lending and puts it more towards their ability to recognize those future cash flows.
The other thing too, why that sort of that 5 million mark it becomes important because or is notable is because we talked a little bit about just the size piece, and you think about it from the perspective of outside individuals. I mean, they're looking for something that's worth their time, right? And if you're at that level, it starts to become interesting because it's worth someone's time to dig into this a little bit, right? There's a lot of companies out there. Where do I want to spend my limited resources of time, right? And where am I gonna get the biggest bang for the buck in terms of my time? So if you're a really small company with a couple 100,000, of EBITDA, your options will be limited just simply because people, there's a narrower universe of people that would be interested in a business of that size. Because, a lot of the diligence, a lot of the underwriting process, it's time consuming, but it's not like it's less time consuming if you're smaller and more time consuming with your bigger. It's nearly the same amount of time consumption.
and I have found that like on the lower ends of the deals, the lack of understanding makes it actually harder, because like you're not actually like speaking the same language of like you're educating someone about the rules of the game while you're trying to get a deal done, while you're trying to build trust, while you're trying to underwrite, like, oh.
And you think about there's usually going to be a lower quality of financial statement available, right? I mean, bigger companies can afford to go out and get CPA reviewed financials or CPA audited financials. That creates greater assurances, gives people, a nice understanding of the financial profile of a business. You get a company that's really, really small, they probably can't afford something like that, and they're working off QuickBooks, and that's fine. But then that takes more time to sift through and understand the line items and understand the categorization and, oh, is this cash accounting or accrual accounting? Well, the smaller businesses is usually cash accounting. Okay, well, what does that mean? So to your point, it becomes more time consuming. And so it's kind of like, well, maybe I just rather spend my time continuing to look for opportunities, look under more rocks until I find something that's around that 5 million mark. Because now it's interesting. It's more of a professionalized business. You've got a leadership team. There's some sophistication there. You can speak the same language. I have CPA prepared financials, gives me, assurances around the quality of the underlying data. Okay, let's jump in with both feet in here.
It's so I think that is super helpful. And what I find interesting of the time and place that my like listeners and clients are in, Jeff, is that it's not obvious. They're not on either of these spectrums. So let me give you some more context. So they're not sucked into like they're not just holding the whole thing on, right? Like, so like call it like 10 to 40 million dollars in revenue. You know what I mean? Like I've got some that are larger than that, but it's a little smaller. Those are outliers, and some that are a little bit, or some that are much larger, some that are a little bit smaller. But they're like, call it let's say 2 million in normalized EBITDA as like the middle of the bell curve. They're still the CEO. They don't really want to be doing that, or they want to be like elevated to a true CEO where they're like working on 80% strategy. But like when I hear 5 million and above, the people that are doing those acquisitions that are playing in the M&A space are what I'm trying to help my clients and audience do, which is become capital allocators, where the only reason it's worth their time is because they're moving money around and there's no assumptions that these people are going to do jobs. They're capital allocators. So it has to be a needle mover for capital allocation, not the job. Whereas in like the lower Main Street, it's like all these transactions are just jobs being bought and sold with an SBA loan. And then in the middle here is my freaking clients going like, we're not one or the other, but like, so what I like to your point about the financials, it's like, hey, if we can show a 3-statement forecast of working capital, debt, taxes, and owner's distributions, we have a higher option, I hope, either A, hiring someone like you below the 5 million. So we could do an ESOP, private equity, or some sort of transaction, even though we might not be that dollar amount, because it's easier for you to promote the story, to get bank lending, whatever it might be. And, or there's a stepping stone of like them going and buying a couple companies, then getting to that 3-4 million in normalized EBITDA. But I think here's my main takeaway, Jeff, is they're in the tweener spot. It's like, it's nothing but cloudy of like, what should I do? Because like, I'm really running it, but it's big enough to be worth and meaningful to something. So like, what are your thoughts about that range of the marketplace?
Yeah, it's kind of that no man's land, right?
It is.
For lack of a better word, you know, I mean, my thoughts are of that size of the marketplace is, yeah, it's at the point. I kind of think of it as an inflection point, right? Where someone needs to decide what they want to be at that point in time, and put the initiatives in place. If you decide that what you want to be is, you want to be at that level, that is that kind of the 5 million EBITDA mark, and then think backwards. What do I need to do to get there? What strategies do I need to put in place today, and over what period of time is it going to take me to build this business into that level? And if it's a lot of time and it's something I don't want to do, can I hire somebody to come in and bring into my organization to help me take this business to that level? Maybe you professionalize your finance team or whatever, or your sales team, or something along those lines. There's some upfront costs there, but in the end, if you can see a clear path to getting there, it's certainly worth the investment. And if you go through that sort of analysis and that self-reflection, and you find that, gee, I don't want to put that much of an effort in where I am.
Effort / timeline, because those are both correlated, right?
Yeah, exactly. And then you just kind of want to, as you pointed out, say just trade jobs. Then I mean, there is a market for that, but it will be limited, and it may not be ultimately at the end of the day the best outcome if you're not running some sort of process that's going to be attracting the most buyers, potential suitors, which is again going to be somewhat limited. So
What would be your thoughts about, so let's say someone does something kind of in between there, which is like, what if they build out, so part of the owner's playbook that I have been building out, and within the next 2 months, I'm going to have all of the material that's the core infrastructure of the playbook out and free. And it's the 3-statement module, or the 3-statement forecast. You have to have a repeatable sales and marketing funnel that generates it's a dashboard that says, okay, client acquisition costs, here's all my revenue lines, here's how I have to generate that revenue at that gross profit, and what percentage of gross profit roll into the gross margins that roll in all the way through the cash flow statement. If we do all of this stuff, then the owner can see their distribution path after working capital, debt, taxes, and reinvestment. So they can see the trade-offs of like, okay, like what if they like just had that slower sustainable growth path, but then they got themselves elevated to the CEO, GM, president position, where I see that as a high possibility and a probability with a lot of my clients. But then there will have to be like this launch off period where like that main strategic mind is eventually replaced, and whether they do an ESOP in that gives them more of a timeline. But how do like the private equity firms and the strategic buyers view a company like that. Like you're kicking out $2-3 million normalized EBITDA. There's good distributions. It's a good, healthy, growing company, but the owner operator, it's not like it's not a dysfunctional reliant on the owner operator. It's like this healthy relationship as a CEO, but they still are necessary. How do you view that?
Well, I mean, I think that universe of buyers that you mentioned is going to look at that business a little bit differently. I mean, and I think if you're talking about a strategic buyer, I think if you're talking about a founder owner that is looking for not just an exit, in terms of ownership exit, but also to maybe transition into more of retirement and not be involved anymore, right? Then that's something that is a a situation where you could find a strategic buyer that would be potentially okay with that because they're looking at obviously their own existing management team and can we run this business with our own team? We just really want to pick up these customers. But that gets a little bit harder for someone that's a financial buyer to kind of get comfortable with because they are going to want someone that can continue to steer the ship and have comfort that someone is there sitting in the appropriate chair to protect their investment, of course, right? That they're making in this particular business, which might necessitate that individual continuing to act in the capacity of a daily, operating.
It's gonna be tied to a earn out or some
It's
sort
gonna,
of rolled
yeah,
equity or
exactly. You're gonna have a
something.
structure that has a bigger earnout if there's if there's some questions around the commitment from that
What kind
individual.
of runway are you needing for someone that is like let's say they actually built out a machine like we're talking about, and they're like, yeah, I'm there because I'm running the monthly management meetings, and I'm like, but I have a head of sales, a head of ops, and a head of finance, and like so there's a good structure there, but I'm still on top. Like you talking like 12-month like could you get a 12-month transition with earnout, but like how much does this have an impact on the deal structure and that person if they've done a relatively good job, but they're still playing the role of the CEO?
Yeah, I think the obviously the longer that your management transition team has been in place to fulfilling these new roles is going to give any particular interested party greater comfort and the ability of that team to deliver certain performance results, financial results, right? In which case, the earnout requirement in terms of staying involved post transaction will be
Could be
less.
less. Yep.
Will be
Yep.
less,
Yep.
right?
Yep.
So if you
Yeah.
have
It's just
someone that
it's
you have one audit cycle, right, gives somebody visibility into how this
like
management team delivered,
yep.
right?
Yep.
One annual
Yep.
audit cycle. How did this team deliver when the prior CEO
It's a good rule of thumb.
hands
I
off
like
the
that.
reins, right?
Yep.
And then if you can show two audit cycles, okay, even better. This management team took one audit cycle. Not only did they repeat it, but they grew the business.
Yep. 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 Yeah. It's just such a it's so helpful, Jeff, because like what I'm trying to constantly tell everybody is like, there's really just no way out of the hard work. Like you're either gonna take a haircut on the valuation, a haircut on the deal structure, or you're gonna have to put the time and the effort in. But the chances of getting like I'm the chances of bamboozling some buyer and to give you, a huge bag of cash at closing is just not gonna happen.
No, no,
Like
that's not.
the effort's just gotta be put in. And like I think like back to your comment about the inflection point, that's really what all of my clients came to and why we started working together. It's like, I'm at this inflection point. I don't know how to weigh my trade-offs of time, cash flow, and wealth. Cause like we're gonna either have to reinvest, which is gonna limit our cash flow, but we're gonna have the wealth kicker when there's an event, or I take more cash. And I think it's like the reason I asked you that question about if someone were to build that machine and kind of, do what I said, they could collect more distributions over like let's say it's 36 months. It's like I got a couple clients where it's like, hey, in 2028, June 2028, I want these options. I want this normalized EBITDA, this working capital. But like if they don't overdo it and they collect good distributions, they can prove they can collect good distributions to prove their fundability. But at the same time, they're also saving outside the business, which would reduce their need for the equity at closing, which therefore would make it like so it's this balance. I'm just trying, it's just a framework for thinking, but it's not like I'm trying not to push it like it has to be this or has to be that. It's like, hey, you could take 500 grand out each year, reduce your retirement amount, But then like here's the evaluation expectations, because you might have to stick for around for a year, and we're just trying to match up their goals with the options.
Yeah, exactly. I mean, just a lot of levers, right? A lot of moving pieces that all kind of go into that, into the equation and whatnot. But I think the key takeaway is, to have the foresight, right? To think ahead, right? And so the clients that you're talking to, of yours, that are giving you a heads up that 3 years from now is my event, that's a good position to be in, right? I mean, the worst case scenario is you haven't had that
Yesterday,
advanced
I wanted
planning.
to.
You haven't had that advanced planning, and now you find yourself sitting there in 2028 going, okay, now I want to sell, but you've not done anything. You didn't think about
Yeah,
it.
yeah.
And by the way, that sometimes does happen because life events happen, unexpected
Mm-hmm.
life events happen, right? And something changes, within the family, or health related reasons that you just didn't see for,
That's why, honestly, Jeff, I've said that, like, I want to eradicate the words exit planning, because people say those words, they do nothing, life happens, they get effed, and it's like, I want to call it the owner's playbook, because you're just building a playbook to run the company like private equity and family office while you own it, and then you might as well have it like when the timing is right for valuation. Who cares? Like, you're just buying and selling assets.
Yeah. No, that's exactly right. I mean, not many founder owners, go into a business thinking about their exit strategy, but buyers of businesses do, right? And just even
Right? Because
before
why
they've
would you buy something that you don't want to sell, right?
even before they've made their investment, they're like, well, how are we going to get out of it one day? And who would we take it and sell it to? So it's kind of along those same lines. It's just, you're just so busy, running the business. You like what you do. Maybe it's a family business or whatever, and you never really think about, how am I going to get out? And so putting that little bit of foresight in mind early on can really alleviate the stress.
Well, and I think what you are providing as we walk through just the data and just the trends is like, it's hard to make those decisions that you just said unless we know how valuations work and how to trade value. Because how do we know if something's worth our time if we don't know how to value things? And so that's why even you just walking through the ranges, the options, I think it's helpful, because if it takes another 5 years to get the normalized EBITDA to 5 million, maybe that's a journey someone doesn't want to spend, but they need to be able to understand that.
Yeah, absolutely. I mean, you should know, I think it's always helpful for folks to know in advance, like, well, what's my business worth today? And then what do I need to do to take my business to a different valuation, right? A higher valuation. I'm not ready to sell today. I'm ready to sell 3 years from now. And what sort of, levers should I be pulling over the course of the next 3 years, so that when that time comes, I'm only going to improve my outcome. It'll be a better transaction. I'll get maybe more value. I'll get a higher valuation, perhaps more cash at close, perhaps less of a risk sharing and earnout, right? And so it's always good to be thinking about like a strategic valuation, where you start to think, what sort of things can I put in place in my business, to really sort of improve that ultimate event.
You have mentioned in previous conversations that I know you guys do and have conversations with people that are just in the learning process. And the reason I have suggested having you on a regular basis, because I know you don't pressure people into getting on the deal train because of the lots of different options and avenues that you can help people with. Um, and so I feel very comfortable recommending people have conversations with you, but I want to make sure it's the appropriate timing for you all as well. So, like, what would be like an appropriate timing for someone for size wise? I mean, obviously the sooner the better. I mean, like I mean, it's the cliche answer, but I'm like legitimately asking from your time investment of like, if you've done these things, like you would be willing to have a conversation with people over a couple years, or is there like, I know you've said you've done some sort of like indication of value, or like, but like what would be the ideal process for you of like, hey, we talked to this person over the course of 2 years. This is what we did over the course of 2 years, and it was worth it for us to do that.
Yeah. I mean, I think, in some instances, again, those businesses that are, right at that size level that we talked about earlier, that are looking to, continue to maybe take it and push it to, the next level. I think is kind of the types of companies that we find where we can add a lot of value, and help them put some plans in place to then take that business to a level of earnings, perhaps where it starts to become a more attractive outcome for them when the time is right.
So let's say I've got a 2 million, I've got a couple 2 to 3 million normalized EBITDA businesses right now where they're damn near done with their 3-statement forecast because they had to hire a CFO, get that stuff and built. But let's say they come to you, is that where it would be help? Because like for us, I literally, it's the next step for like almost a half a dozen of my clients now. It's like, now we've got this out, the forecast. Let's talk to Butcher Joseph or a Prairie Capital or someone that does all of the options. Say, okay, Butcher Joseph is now going to sit us down and walk us, like, shoot holes in this, right? And like, what would the ESOP valuation be versus a third party? Because like, what I'm trying to do, Jeff, is like, let's say they've got that 3-year plan. What I'm trying to help people do is like, okay, we got their ideas in numbers actually, but what I want from a party like you is to be like, here's the level of eating shit that you have to go through for 36 months to get here and what we would have to need in order to actually get what you want. It's because you are going to know what actually has to be done to market that, outside of just the cliche of like, good leadership team and good financials and kind of the normal playbook. But like, is that the size? And like,
Yeah,
you
it's
say,
a good
okay,
size.
like,
Yeah,
okay.
yeah, that's
Because
a good
you
size.
talk like 2-3 years of work, and then that time investment for you would be worth the effort.
Worth the effort. Yeah, absolutely. Yeah, because those are businesses that are nice businesses. Hmm.
That I think a lot of my clients would agree with that. It's just trying to
That's
figure
good.
out like who's going to pay attention to them. It's been an interesting challenge because it's like, they're not the 5 million, but they're not the, ma and pa, retail company. And so it's a very lonely desert for
Yeah,
that
no,
space.
there's that. I get it, and I think those are good sizes, for us to kind of assist with when those opportunities arise.
What should we regroup on next quarter? Is there anything you're paying attention to that would be worth bringing back up? Obviously, tariffs, interest rates as the 10-year goes up and down. Anything you want me to ask Alan Folio as far as it relates to the economy?
Yeah, well, exactly what's going to happen.
Yeah, right.
You can ask her that. I mean, it's interesting. You see all the data points, the macro data, unemployment rate, jobs numbers. I mean, a lot of this, there for a while, everybody's been, kind of talking and worried that we might be on the cusp of some sort of recession. We have not seen anything to that extent quite yet, obviously. And I think as we look back, 3 months from now when we get together, it would be interesting to see how this whole thing plays out. And so,
Right. One
um,
thing that I'm looking at, and I'm going to want to come back to you and ask about, is like, so we are going to have to print a lot of money in the next couple of years. And like, there's a high correlation between the demographic cliff and the Fed balance sheet and M2 liquidity. And my question that I have been toying around in my head is, how does the money printing that increases asset prices? So like, there's been a like if you see it, Jeff, the M2 money supply growth and the Fed balance sheet and the correlation with the Nasdaq is like 97. It's like insane because you print and the denominator is just growing. Like, even though we didn't do shit for it. So how does that, I think that's showing up in the PE ratios of the public companies now. And it's showing up in the asset inflation of commercial real estate, housing, Bitcoin, all of these, gold, all these hard assets. So how does that show up in the multiple or the deal structure? Because at the end of the day, you and I and the people listening in, we deal in the world of real cash flow. So like, the valuations can go high, but like in public companies, it's all freaking gambling and all this shit. But like, at the end of the day, you and I and the people listening in have to service our debt, fund working capital, and have cash. So how does that inflation actually impact the valuations? Or is it more of these are inflation proof assets that are able to raise prices and
yeah,
adjust accordingly?
I think it depends on whether or not you can capture the inflation when and pass it through to your own customers, right? I mean,
What's the potential option or elasticity of the ability to do that?
yeah, exactly,
Yeah.
right. I mean, if
Yeah.
you can't pass those inflationary costs that you're bearing through, then clearly your margin profile is going to be negatively impacted. And if your margin profile is negatively impacted, your dollar, the earnings themselves are coming down, and that's going to be more of a negative trend, and it's going to impact the pricing multiple that someone's willing to pay, and it's going to destroy value, not help value. You have to be able to keep up with the inflation. Just keeping up with the inflation just kind of preserves your value, right? I mean, it
Yeah,
preserves the
which by the way, you look at the S&P 500 at 12%, it's like barely been exceeding I mean, it's the cost of capital, and you throw on the money printing of 8% roughly a year, and most people are just treading water. But it's fascinating. So that back to like what I'm interested to monitor in our future conversations is how are buyers and lenders looking at, so they're looking at tariffs right now because it's all impacting future cash flow. But if this really starts to, ramp up over the next 6-12 months, like, does that become part of the conversation for lending and for investors going like, because like how much can you actually pass on to the customers is I think going to be a conversation people are going
It
to
will
start
be,
having.
and there may be some shared pain, right? I mean, companies may not be able to pass through the whole full 100% amount of the impact. There may have to be some shared pain throughout the supply chain, in which case there is going to be an unfortunately a negative impact to the margins and the earnings of the business. And order of magnitude will become super important, obviously, because that just and that's going to detract from the ability to service any new debt you put on the balance sheet, take dollars away from available capex, spend, working capital, all the things that may be used in a more productive sense.
Yeah, sounds like the government could take some advice from that comment. Jeff, this has been fun. Thank you so much for your time and the insights. I will push it. We'll put the link to Butcher Joseph and all the articles and stuff like that you guys normally have. I'll put that in the show notes, and I appreciate the time, and we will see you next quarter.
My pleasure. Thanks for having me, Ryan. Good to see you again.